Social Security gave retirees a 2.8% raise in 2026. Sounds like good news, right? But there's a catch. The tax thresholds didn't rise with it, and for some retirees that means part of that COLA increase could quietly disappear into taxes. Let me show you exactly how this happens. Here's what changed in 2026. The Social Security COLA increased benefits by 2.8%. For the average retired worker, that raised the monthly benefit from about $2,015 to $2,071, roughly $56 more every month. That sounds like an extra $672 a year. But before you count that money as a real raise, there's one number you need to see, because this number hasn't moved at all. Here's the problem. While Social Security benefits keep rising with inflation, the income thresholds used to tax those benefits have stayed frozen for decades. For a single retiree, the first threshold is still just $25,000. For a married couple filing jointly, it's $32,000. So every time your Social Security check rises, more retirees can slowly get pushed closer to those tax lines, even if their real lifestyle hasn't improved at all. Here's why this matters. Imagine a retired couple receiving Social Security, taking regular withdrawals from an IRA, and earning a little interest from savings. Their lifestyle may not have changed at all, but when Social Security rises because of COLA, their combined income can rise just enough to make more of their benefits taxable. So the raise they see on paper may not be the raise they actually get to keep. Let's put real numbers on this. Imagine a married couple receiving about $40,000 a year from Social Security plus $23,500 from IRA withdrawals and savings. Before the COLA, their combined income sits just below the $44,000 threshold. Then Social Security increases. Their spending habits haven't changed. Their IRA withdrawals haven't changed. But suddenly, that small COLA can push their combined income across the line where up to 85% of Social Security benefits may become taxable. And this is the part many retirees miss. A COLA increase doesn't automatically mean more spending power. If that higher Social Security benefit causes more of your income to become taxable, Uncle Sam may take a piece of the increase. And taxes aren't the only pressure. Your Medicare premiums and everyday expenses still matter. So the number on your Social Security check can go up while the amount you actually feel in your monthly budget barely moves. And there's another number you need to watch. For single retirees, $34,000 is the upper Social Security tax threshold. For married couples filing jointly, it's $44,000. Cross that second line, and up to 85% of your Social Security benefits can be included in taxable income. Again, that does not mean an 85% tax rate. It means a much larger portion of your Social Security can now be exposed to federal income tax. Here's what makes this problem so powerful. Social Security benefits are adjusted for inflation year after year, but the income thresholds used to determine whether those benefits are taxable are not automatically adjusted for inflation. Think about what that means. Your benefit keeps moving higher while the tax line stays in the same place. Over time, more retirees can cross those thresholds, not because they suddenly became wealthy, but simply because their Social Security benefits kept rising with inflation. And taxes are only half the story. COLA is based on a national inflation measure, but your personal retirement expenses don't necessarily move at the same rate. If more of your budget goes toward health care, housing, insurance, utilities, and groceries, your actual costs can rise differently than the COLA you receive. That's why a Social Security increase can look good on paper while your checking account tells a very different story. The number that really matters isn't your COLA percentage. It's what you can still afford after the bills are paid. So don't judge your COLA by the percentage alone. What matters is how much of that increase actually stays in your pocket. So where can your COLA actually go? Part may disappear into higher taxes. Another part may be absorbed by Medicare premiums, while rising everyday expenses take another bite. The important question isn't whether your Social Security check increased. It's whether your net monthly cash flow improved after taxes, health care, and the bills you already have to pay. Here's the good news. You can't control the COLA, and you can't control those frozen Social Security tax thresholds. But you can pay attention to the other income that pushes you toward them. IRA withdrawals, investment income, and other taxable income can all affect the calculation. That's why retirement tax planning matters. Before taking a large withdrawal, look at your total income for the year, not just the amount sitting in your Social Security check. This is where one retirement decision can make a big difference. Suppose you need extra cash from your IRA near the end of the year. Taking the full withdrawal in December could push your combined income above a Social Security tax threshold. But depending on your situation, spreading income across tax years may produce a very different result. The key is to look at the tax impact before the withdrawal, not after it. And this is why the account you withdraw money from can matter. A traditional IRA withdrawal generally adds to your taxable income, but a qualified Roth IRA withdrawal generally doesn't. That difference can be important when you're already close to a Social Security tax threshold. Two retirees could spend the exact same amount of money, but depending on where that money comes from, the tax result may be very different. That's why smart retirement planning isn't only about how much you withdraw, it's also about which account you withdraw it from. So before the end of the year, check three numbers. First, estimate your total Social Security benefits. Second, add your IRA withdrawals, investment income, and other taxable income. Then compare your combined income with the Social Security tax thresholds that apply to you. If you're getting close to one of those lines, don't wait until tax season to discover it. A little planning before December 31st can give you more options than trying to fix the problem after the year is already over. So, what should you do in 2026? Start by estimating your combined income before making large withdrawals. Watch how close you are to the Social Security tax thresholds. And don't assume a bigger COLA automatically means more money to spend. Focus on what remains after taxes, Medicare, and your essential expenses. That's the number that determines whether your retirement purchasing power actually improved. So the biggest COLA mistake is thinking the percentage tells you whether you're better off. It doesn't. Your real result depends on taxes, Medicare, inflation, and where your retirement income comes from. In 2026, don't ask only, how much did my Social Security check increase? Ask the question that actually matters. How much more purchasing power do I have left? Subscribe to Retirement Roadmaps for more strategies to protect your retirement income, and watch the next video, because every dollar in retirement matters.